Investment risk you should consider when you start your investment to avoid the risk for your financial balance. All types of investments, whether it's stocks, gold, or property, must have different risks. There are those who dare to take high risks, are hesitant, and don't even dare at all. Therefore, you should identify the type of investment risk first so that you can choose the right investment instrument. One. Interest rate risk. Interest rate risk is the risk that arises due to fluctuations in interest rates. For example, loans or bonds. Usually, this type of investment will deteriorate due to an increase in interest rates. If interest rates rise, the price of interest-bearing bonds will still fall, and vice versa. This risk is generally measured by the term of the bond. For example, the bond interest rate is 8 to 10%. But then the government issued retail SUKIK with interest rates of up to 12%. That way, investors will like it. 2. Inflation risk. Inflation risk is also known as purchasing power risk. This is an opportunity that the cash flows from investments in the future will not be of as much value as they are now. This is due to changes in purchasing power due to inflation. This has the potential to harm people's purchasing power for investment, because there is an average increase in consumption prices. Inflation risk is chosen by investors when holding cash or investing in assets that are not related to inflation. Three. Market risk. Market risk is the fluctuation in the value of net assets that occurs due to changes in financial market sentiment. Market risk or systematic risk is unavoidable and will always be experienced by anyone in the investment world. This can even result in a capital loss for investors. This change could be caused by many things, such as economic recession, issues, riots, and so on. If that happens, you should not rush to panic and immediately withdraw your investment funds. Because usually the decrease or increase does not occur continuously. Four. Liquidity risk. The next type of investment risk is liquidity risk. This is a risk that arises due to constraints in providing cash at a certain time. For example, if someone is unable to pay their maturing obligations in cash. Even if the person has assets of sufficient value to pay them off, when the assets cannot be converted into cash, the assets are still said to be illiquid. This type of investment risk tends to occur frequently in the banking industry. Foreign exchange risk or currency exchange rate. Foreign exchange risk occurs due to changes in foreign exchange rates in the market, which are no longer as expected, especially when converted into domestic currency. This type of risk is related to fluctuations in the exchange rate of the rupiah against other currencies. Generally, foreign exchange risk is also known as currency risk or exchange rate risk. For example, an investor wants to make an investment that requires using the USD currency. At the same time, the IDR exchange rate against the USD was weak, so investors had to spend more rupiah than when the rupiah strengthened. This is what causes losses. 6. Country risk. The next type of investment risk is country risk or political risk. This risk is based on the country's political conditions. So if there is a change in the provisions of the legislation, it will also have an impact on income. That's why it's important to look at the political conditions of a country before you invest there. If the political conditions are good, the impact on the investment world will also be positive. 7. Reinvestment risk. Reinvestment risk is the risk in earnings from a financial asset which requires the company to reinvest. When they want to do this, companies must really understand what reinvest is and how to manage this risk.